你好吗? Okay. G'day, mate. Hello. How are ya? How's your mum? Good morning, everybody. Hey, it's Monday. We're almost to September. Isn't that amazing? Well, welcome to Forex.Today, the YouTube community of almost 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne McDonald. I am a currency trader like you. I've been doing this a while, and I can share my experience in hopes that it'll help you focus the development of your Forex trading and find improvements, make tweaks, look at the big picture, look at the small picture, sweat the details, all that kind of stuff. So let me know how it can help. Today I recommend we go through gold, oil, Bitcoin, dollar pairs, yen pairs, pound and euro specifically. And we'll just see how the world is shaping. So ask questions. In the description below the video, there's a link to all kinds of things. There's a link to my book. There's a link to free training courses. There's a link to paid training courses. There's a link to a trustworthy, ethical foreign exchange broker, tradersway.com. Recommend you give them a try. Fast execution speed, narrow spreads, huge swaps, ethics, trustworthiness. But don't take my word for it. Visit tradersway.com, open up a demo account. See if they'll earn your loyalty and respect like they earn mine. Tommy's like, hey, you're looking good, Wayne. No, thank you. I worked out all weekend. Yep. Yeah. Cool. All right. So looking around the world here on the smaller time frame, you see that Great British Pound is quite weak today. That's great. Yen is quite weak today. Great. Dollar's given back some over the last couple of hours. Kiwi has lost value. So has Aussie and CAD. So let's take a look. Let's start with pound pairs. Okay. Moving sideways, but as you notice, both of these are weak. So the question really, will one gain strength over the other, or will this move sideways? Bears are thinking something like that. Okay. And that would be based on the role reversal and the idea of a lower low. But right now, Kiwi is very weak, and so is pound. So I'd probably stay away from this. But look, you can be a bear on that. So that's how you'd set that up. I'm a bear on this one. Currently, the weekly swing trade is almost done. So we got to like really zoom in here. And boy, did this gap down, huh? Holy smokes, a little gap. Filled the gap down. Notice that we're inside the August projected low zone. The weekly target now, if you're going to kick it off the roll reversal and off the moving averages, the weekly target is 151.84. So let's just say 152. And that should be just a big out. Now you'll see just above 152 at 152.13 that we have an overlap of the monthly S2 and a weekly M1. So make a decision. Okay, there's the overlap here. This would be the technical target, and then there's the psychological level, right? So one of those. Okay. Coolio, right? It's really tight. It's really tight, but fundamentally this should be pretty good. At some point, like if we're going to look a little further out, we would want to test that price up there for a sell. But right now we're following the mean. The mean is right there. I ordered a new mouse. I think it's arriving tomorrow. This mouse is just no good. So anyways, we're following the mean, but at some point you would expect this to go head up there. But the fundamental trend is quite strong on this to the downside. And I'm just wondering if the new money just comes in and we hit the bearish target before we do a pullback. Like, you know, I'm just wondering if the new money just comes in and we head down here first before there's a pullback. Because typically you would do this. But hey man, those fundamentals are quite strong. Take a look at pound Swissy. A lot of resistance above us. Okay. So again, the reason they're here is that you want to observe these levels to see if it holds price down and confirm this lower low. Pound Aussie. Okay, again, this gray zone is the projected low for the month of August. We fulfilled the pattern on this and many others quite early. There's the August sell, and there's the August target. So we were done by even before the 15th. This is a whole reset. Okay. And right now, currently, we're just riding the 4-hour 21. We're kicking off of the weekly central pivot. Target is going to be 167.62. So down. Oh, that's my mouse again. Down. So I'll do it this way. Okay. But that puts us out of position, so you want to keep riding that 4-hour 21. So next week would probably be something like that. And pound a dollar, just like several others. We'll say that, okay, this is the best projected selling price. Remember, bulls and bears. That's the best projected selling price for bearish trending. And that target, or that produces a target of here, which we hit. There was a pullback, and this looks like it could be a September front run. And if it is a September front run, then that target is going to be 112.37. So probably look more like down, up, down, that kind of thing. The ultimate target is down here, like I said, 112.37. So maybe like this. If it's a new money flow, though, you know, I wouldn't be shocked if it was more like this, and then you get your 3-wave correction if you're an Elliott wave dude or dudette. All right, cool. Let's look at I guess euro. It's another one I'm bearish on. Okay. Euro seems to be generally weak. However, Kiwi seems to be even weaker. So that's interesting. What this is displaying is an inside month. Now you're like, well, why can't it go higher? Well, it can. I'm just looking at the pattern. So, I mean, that's that. It just is, man. It just is. So we'll see. I don't know if Kiwi's going to get strong, but maybe Euro gets weaker. Yeah, I don't know. Okay. ECB is really starting to turn hawkish. And so they're waking up to the fact that they may have to jack up interest rates to try to keep up. So if this is a reversal, because look, you can say we're trying to hit a higher high. Well, we haven't got through this. Okay. So I think a trend trader is still going to think like this. However, it's really rangy now because of this situation. Okay. So it made a lower low and then it bounced up and made a higher low and now is up here. So for it to go back in the prevailing direction is, you know, not as, I mean, it's a little less likely. So like the old trend was going in this direction. So it'd need to happen soon, but it's not necessarily lower low, lower high stuff anymore. Okay. Yes, Mubarak, that's exactly what's going on. There was a lot of rhetoric over the weekend towards that. Okay. So the question is, Mubarak, is does that new information change the existing trend? Will that create opportunities to invest into Europe? Or is it like temporary? Like, okay, great, they're going to raise interest rates. However, if they jack interest rates all the way up to 1% and they have 10% inflation, in real terms, you're still losing 9%. So if you don't think so, then you want to look for that pattern I just showed of maybe sideways, so down to the bottom of the trend and then back up, and then at some point a breakout to the downside. Okay. Well, Richard says temporary because we still have high gas prices. Well, I've been talking about natural gas in my oil trading course recently, and I've been talking about prices of natural gas in the United States and prices of natural gas in Europe. And I've been saying 40 or 50 over the last couple of weeks when I'm talking about prices. But it went up to 300, I think, and in one case 1,000. So last week, European natural gas prices were up hundreds of percent. And have dropped very significantly in the last couple of days. So maybe that's a relief rally for Europe, right? Let's see if I can get Let's see if I can get this. Yeah, okay. This will do. That'll do, pig. That'll do. All right, here's European natural gas prices. Okay. Since June, it went from a low of 100 to almost 350. And if you look here, you can't even do it. Why isn't it giving me a price? It's so... there we go. Yeah, so we are looking at... It used to be like 17. Now it went to 350. But look at the giant drop we just had. It went from 350 back down to 270. So maybe that's a relief rally for the euro where they're like, oh my God, that is such good news. It's only 280. In the United States, it's 10. 10. In Europe, it's 280. And there's something going to radically change in the next couple of months that everybody in my oil trading course is ready for. So I guess you should be in the oil trading course if you think that's amazing. So nat gas prices are way down in Europe. From 380 to 280, huh? Amazing that it should be about 10, between 10 and 20. It's amazing, isn't it? Amazing. Okay. Here's one play. Europe buys natural gas. Norway sells natural gas. Okay. So if I were me, I would look in that area for a sell. Ooh, I didn't want that. Here we go. Shields up. Red alert. How do you identify it? You just log on to the website. Baker Hughes. Right? So I just go to the website. Okay, 3 more rigs came online in the United States, none in Canada, and 9 internationally. Okay. Okay. Is that a big deal? 3? Well, it's 257 more than a year ago. Cool, right? Let's do gold, oil, and Bitcoin. Okay. Oh, I missed. Oh, look how close I got. Missed my entry here. All right. So anyways, my WTI, it's done a 382 Fibonacci retracement 3 times. I was hoping to catch it around 50%. And therefore, the target is 105. Is that right? I guess so. No, that seems wrong. Oh, no. The target is 96. 96.30 or 9. We'll say 96 and a half. Okay. So I'll see if I have more chances to grab that. Okay. Big risk off on Bitcoin. Okay, notice the collapse. Remember how we talked about it potentially occurring, that I expect risk off to occur in late August. Bitcoin is one measure, and we broke out on the exact week. And you're like, what do you mean in the exact week? In January. Okay, I pointed out that Monday and Friday of last week, okay, 3rd week of August. I said back in January, I did a 1-year outlook going month by month by month. What would happen in the stock market, what would happen in the currency markets, and all that kind of stuff. And so I said in the 3rd week of August, we would have this move. And typically I would expect the opposite, but this year for cyclical reasons, I would expect down and not up. Okay, so cool, it occurred, but this confirms risk off mode right now. Okay, there's been a dramatic shift to risk off. And by dramatic, I mean 10% increase in risk off positions. 10%, week over week. Take a look at gold. Okay. That's what I had planned out last week, and it's come down partially. Okay, so what we're doing is we're kind of tracking that out. And okay, we might have done this one in the swing trading group, in fact, I'm not sure. But anyways, so we already have the target identified of heading down to $1,685.46. Right now you can see we had our move. Now it needs to make a lower high and then make a lower low. Look, this is why I bought a new mouse. It's on the way, man. Hurry up, Amazon. Anyway, so now we need to hit the weekly target and then hit the monthly target. It might take a couple weeks. Bernd says, isn't that also because of the high dollar? No. The high dollar is because of the risk off. The high dollar does not create risk off. It's a symptom. Okay? You don't have a hole in your stomach because you're bleeding. You're bleeding because you have a hole in your stomach. And it's really the shotgun's fault. So again, The blood isn't what's going on. The hole in the stomach is the consequence of yet something else. And what's the something else? The shotgun. Right? So you got to focus on the shotgun, and then the hole, and then wipe up the blood. Wiping up the blood doesn't do anything. So anyway, so the strong dollar. So like when analyzing, I look for the reasons of risk increasing, and then I buy the dollar if risk is increasing, right? So that's what I mean. So it's the increasing risk that people identify that make them buy the dollar. But you got to be careful because there are a lot of people that might say it backwards. They might even think it backwards. Okay, it's correlation versus causation. So again, if you're listening to some YouTube guru that says, you know, there's risk off because the dollar's strong, you should probably, I don't know, back away slowly or maybe quickly. Right? And you're like, why? Well, they don't quite understand. They know something's going on, but they're not observing it correctly. So again, what they're telling you is if you eat enough ice cream, the temperature outside will go up. It'll get warmer outside if you only eat enough ice cream, right? Because everybody knows when ice cream sales go up significantly, the temperature outside goes up as well. So clearly, consumption of ice cream heats up the environment. In fact, ice cream might be the reason for global warming. I'm just saying, because I tracked the numbers. Well, you got to be careful when you're doing data, right? Correlation or causation. Well, it turns out really humans like to consume cold ice cream on hot days, and it's the hot days that increase ice cream sales. So anyways. Is that right, Maria? That's cool. Correct. So it's because of a reserve currency. And by the way, I know I got a lot of projects going on, so I'll probably never get to this. But I have interest in finding the history of the use of reserve currencies. But I was thinking how similar the early days of the use of money created really the first cryptocurrency. Okay. And imagine how things started back in the day. Okay, you had country A and country B. They wanted to trade with each other, but they're on the other side of the world. So Spain and I guess you can do it like that, right? And Portugal. No, Spain and no, let's do this. Brazil and Portugal. Yeah, let's do that. Okay. Back in the day, when you did business with each other, okay, what you would have to do is fill a boat with gold, send it to Portugal, and then Portugal would unload the gold and then load another ship with whatever the Brazilians needed, and then they would send that ship back and forth. But you would actually have to send the gold back and forth. And well, what if the galleon hit a storm and sunk to the bottom of the ocean or got robbed by pirates? So at some point, a Brazilian bank would say, well, we have this bank account full of gold and we guarantee it to be true. So we'll send a piece of paper to Portugal. And now the bank in Portugal will have the paper, a piece of paper that says it owns the gold in Brazil. And after a while, you're just sending the paper back and forth. A lot less risky than actually sending the actual gold. You see how that's kind of like, it's a ledger to ledger trade? It could be the same bank, the Bank of Portugal, right? So the Bank of Portugal having two different branches, one in Brazil and one in Portugal, could just on a piece of paper, on a ledger, on a accounting ledger, just say this asset went from this account to this other account, but the gold never moves. And to me, that's it's not physical money. It's just a ledger entry. And to me, I'm like, well, isn't that like a cryptocurrency? Like, it's a bit of a stretch, but I'm like, that's interesting, huh? Where you didn't have to spend the money. Okay. So wouldn't it be interesting to do research on just those early concepts, those early days of international banking? I think that's fascinating. Like, for example, let's carry that thought out further. In I bought a new mouse, by the way, right? I'll say it again. All right. In 1960, what did the Fed do to accomplish its dual mandate? What was the main tool? What was the Fed's main tool to accomplish its dual mandate? I'm doing my best. Fed tool. Anyone else want to guess? Thank you, Johnny. Hunt for Trade says interest rates. Gold. Question mark. Okay, thank you, everybody. All right. One of the concepts we cover in, I think it's the monetary policy course at FX Bootcamp. No. By the way, okay, let me do a quick answer. Not interest rates, not gold directly. In fact, by 1960, they had already lost control. Inflation back to 2%. Not in 1960. There was no inflation targeting. In fact, it was assumed that other things took care of inflation. So back in 1960, they didn't tell you they changed interest rates. You just kind of figured it out based on what was happening in the market. So they never declared what the interest rate was. In fact, they didn't even really manage the Fed funds futures market. All of that is a much newer construct going back to maybe 1980-ish. Maybe, let's say, post Paul Volcker. Maybe. Okay. But back in 1960, what they looked at was the cause of inflation. The only cause of inflation was, I'm going to try to draw this, money supply. So they defined money. Okay, and you'll remember this during the course if you took the course. M1, M2, and M3. How often do you hear the Fed talk about M1, M2, or M3 in their press conferences and interest rate decisions? None, not at all. So what they stopped talking about this back in, like I said, let's say around the Paul Volcker era. Why did they stop talking about M1, M2, and M3? Those are different definitions of money. M1 would be cash and money in your checking account. Because you can write a check and spend it today. And then that goes through the banking system and gets into the other person's account, but it's pretty quick. Or you could just use cash. Now, M2 would be cash, checks, and a savings account. But remember, savings takes a little longer. You have to think about, especially 1960. So, money would have to be moved from your savings account to your checking account. And then you would write a check, and that would take a couple days to clear. It's not as good as money, but it's pretty close. Now, of course, in the modern world, you're like, dude, you can do anything super quickly. You could even send somebody a Bitcoin and buy something, in an hour or less. But you have to go back to these traditional definitions. So M1, M2, and M3. M3 would be other types of assets that you could convert. Like gold would be M3. You can't go to the grocery store with an ingot of gold and convert that into bread, eggs, and milk and get accurate change. Because they're like bread, eggs, and milk. What is it, 2 slivers? You have to cut a little sliver off the edge of your ingot, because your ingot might be worth 20 grand. So to buy, $9 worth of product would not be easily convertible. So what you'd have to do is take your ingot, convert that into cash, and then take the cash and then go over, all that kind of stuff. So around 1970, let's say in the 60s. So by the time we get to, I'll just throw down a number, let's say 1975, the Fed started to realize it didn't know how much money there was. Okay, there was actually something they called the missing money. This is what central bankers were trying to figure out around that period. Where's the missing money? They know there's money out there, but it's invisible and they don't know where it came from. It's like scientists know there's dark matter in the universe. They just can't see it, but they know it's there. So the Fed realized, oh my God, see, if there's too much money, you get inflation. So instead of changing interest rates, back then what they would do is just remove some money, reduce M1, and reduce inflation. But do you remember that whole Jimmy Carter period in the late 60s and early 70s where inflation in the United States was crazy high? Well, they started to realize, they meaning the Fed, there's there's more dollars in the world than the Fed knew about. And not like a little bit, but a lot more. In fact, I think by the time you get to about 1980, and inflation in the United States was crazy high, I think they realized there might be more US dollars outside the United States than inside the United States. So how is that possible, and why would the Fed not know? Well, you go back to Bank A and Bank B, okay? And now instead of, we can still use Brazil and Portugal, but let's say it's 19, wow, 9, that's a 1, 19, that's a 9, 6, wow, 65. Yeah, good. Yeah, good thing about a new mouse. Anyways, so in 1965, let's say now these two countries obviously are not related through imperialism. They want to do business in dollar because they don't have to worry about their individual exchange rates, but they do business with other countries too. So not only do they do business with each other, but they do business with a whole bunch of other countries. And instead of having the central banks having to hold significant amounts of 20 different currencies, you can hold significant amounts of one currency. So that's where reserve currencies come from. So anyway, so you got this, we'll just say you got cash in Bank A, and instead of now putting it on an airplane and flying it to give the cash to Bank B, they convert the cash to basically just journal entries, and then they send it kind of over there or back. But what these other banks are doing is then they have the reserve requirement ratios, right? And they take some of these assets now, and they put in their central bank, and then they have 90% of that asset to lend out. So what happens is you get the fractional reserve banking system happening over here. Reserve banking. Which means if this was $1 million transaction and now Bank B got the $1 million of transactions, okay, they have 900,000 left to loan out. And that goes through the banking system, and at the end becomes 9 million. So here's the interesting thing. This whole thing happened outside the United States with dollar, and Bank A transferred $1 million to Bank B, and over a period of time, the $1 million transaction ended up creating 8 million more US dollars. You guys following along on this? So now you have onshore dollars that the Fed is tracking and believes they're in control of. Then you have offshore dollars that the Fed has no way to track. And a $1 million transaction eventually turned into $9 million worth of offshore dollars. And at the time, in 1965, that's 1965, the Fed was oblivious to this. And they're like, where's all this inflation coming from? So they would reduce the money supply in the United States. And there was still inflation. So anyways, the Fed doesn't do that anymore because they assumed if you lowered the money supply, inflation would fall, and it never did. So now they don't even, I don't think they ever say it, but they don't talk about M1, M2, M3 anymore. They talk about interest rates. Meta says, what will happen if the world stops using US dollar to buy oil? Well, you have to realize that that'll probably happen, but they use dollar because it's a reserve currency because they want to do it. Okay? They want a reserve currency. So there would have to be a want to use a different currency. And so maybe you get like a cartel situation where, Russia and China and India and Saudi Arabia and Iran and Iraq and let's say all of OPEC, let's say OPEC plus, they all agree to use this second currency for transactions. That could happen. So what would that do to the US dollar? There'd be less demand for it. Okay. Okay. All right. Oil's Oscar Mike, right on time. Holy schnicker. I missed it by 2 shakes of a lamb's tail. I got to leave. Daddy's got to go to work. Hey, thanks for being on my team. Peace on earth. May the pips be with you. May your profits be above average.